Futures are flat. They were down overnight, but have reversed back to flat. And that came alongside a reversal in bond yields. Everybody's got their eye on the 10-year yield lately. This cycle of everyone staring at yields started with the 1 and 2 year during the midst of the Fed rate hike cycle. And now that conversation has turned for not necessarily lots of rate hikes in the future, but more of a higher rates for longer, focus has turned to the 10-year and even the 20-year and 30 years. Everybody's got their eyes on 30-year mortgages, things like that. So everyone's got their eye on the yields, and they reversed overnight. This comes after the sell-off we saw yesterday, which took the markets down about 1.5% on average. That was much more than the expected move for the day, obviously, and that has basically held consistently as a 1.5% expected move for the balance of the week. Now, of course, that includes a Friday morning's jobs report, the non-farm payrolls number. And I think it's safe to assume that most market participants will be looking for some sort of Goldilocks scenario where the economy does not look like it's coming to a screeching halt. However, it doesn't look so hot that the Fed needs to stay hawkish. The VIX is hanging out around 20, which for those looking for a spike in volatility to signal some sort of buyable, tradable bottom or low in the market, I have some good news and some bad news. So that this level over the last, say, 6 months or so, since we've seen such low volatility late spring and summer, a 20 VIX did actually mark a bottom in the market several times. However, if you go back before that in spring, going back to March, and obviously last fall, sell-offs in the market were steeper and volatility spikes were much higher. So this is as we've been saying on the orbit for the last month or two, this does seem like a new vol regime. And so for those looking at the VIX for signals, they might want to back up the charts a little bit, at least a year. So on the chart here, we're looking at TLT, which is actually indicated up pre-market. And as you can see from this 1 year chart, this has been wild. And bonds and bond yields do not typically move like this. So as you can see in this last month or so, we've seen a 10% down move in a straight line. But going back to where it was in spring, that is TLT is down 21% or thereabouts. So these are some pretty wild moves in the bond market. Now, what's interesting is going back to the last fall, the TLT was seeing some wild swings of at least 10% back and forth. And then if you notice, it settled down in quote unquote settled down. It was still moving, but it was moving within a range of about 6 to 7% over the summer. And then it started this steep decline to where we are now. So I wanted to use this as an example of how sometimes you can use options to be contrarian without actually having to get the direction or magnitude of a move perfectly correct. And I'm just using TLT as an example. I obviously have no idea where bond yields will stop. But what we're doing is we're looking out to December 29th here, and let's look at some neutral trades here. And as we can see, we bring up the Iron Condor December 29th expiry. That gives us a break even of about 78 to the downside and almost 93 to the upside. And so basically what this positioning is doing is saying it's positioning that TLT will stop its crash at some point soon. And it's not necessarily saying oh, it's going to reverse and it's going to go higher. It's basically saying the movement that it has seen over the last month or month and a half may soon come to a stop. The other potential positive on a trade like this is you are taking something that has seen recent high volatility and you are being short that volatility or vega. So if TLT were to suddenly stop its downward trajectory even slightly and had slight bounces, you would see vega, if that was sustainable over weeks, let's say, you would see the IV of these options start to contract a little bit, possibly significantly, and a position like an Iron Condor, an Iron Butterfly, a credit put spread, credit call spreads, all of that stuff contracts as IV comes in. So you're on the correct side of IV going down. Now, if you did this trade and IV continued to go higher and the stock continued to go down, obviously, this is not the correct position. The same thing is where you can lose on a trade like this is you're just wrong and it does bounce and it bounces hard and it takes you out to the upside. And that's something people have to be very careful with when they are selling IV in a high vol environment, whether that, I mean, it could be any chart, any stock that looks like this, that is crashing right now. When you're doing a neutral position like this, you are position yourself for it to stop on a dime to some extent and go sideways. If you are playing for a stock to reverse hard and go higher, you have a couple of options there. You have credit call spreads to a certain level, especially near term. You have credit put spreads, which are taking advantage of that high vol, positioning bullishly for a bounce, but also not having to be exactly correct as to the magnitude of that bounce, just needing a bounce. And then, of course, those are on the correct side of higher volatility. And that's it for today.